weighted average number of shares would be increased by the additional shares, and the numerator, net income, is increased by the amount of interest expense net of the tax effect associated with those potential common shares. So if we're talking about potential conversion of debt instruments, we would use the if converted method. For options and warrants, we would measure them with the Treasury stock method. And the Treasury stock method basically pretends that we're issuing the new shares out of Treasury stock, which is shares held for the purpose of future issues. So whether or not the stock options and warrants are currently exercisable, so if they're European options, they're exercisable only at the very end of the exercise period, whereas American options can be exercised at any time. So even if they're European options, they would be included in diluted earnings per share unless they're actually anti-dilutive. And we use the Treasury stock method to determine that. The Treasury stock method assumes that the options or warrants are exercised at the beginning of the year, or the date of issue if they're actually issued later in the year. And so it reduces the amount of period in which the proceeds could be used for earning income. The proceeds from the exercise of options and warrants are used to purchase common shares from the Treasury. And so for both the options and the warrants, exercise is not assumed unless the average market price of the shares is above the exercise price during the period being reported. Because they wouldn't be dilutive, except in the case where the exercise is the average market price is above the exercise price. So we're talking about a call option, so it's only in the money if the average market price is above the exercise price, essentially. So so you would get the proceeds at the exercise price, and then you'd have to issue them essentially at the average market price. So the number of new shares issued would be less than using the proceeds to buy shares at market value. So that's why it would be dilutive. Complex capital structures require you could have up to three categories for basic earnings per share and another 3 categories for diluted earnings per share. So you might actually see 6 different categories on your income statement. And so the if converted method, which we briefly chatted about in a second ago, the conversion of the securities into common stock is assumed to occur at the beginning of the year. So we assume that we convert it immediately, and the net income must be adjusted for any interest or dividends. Interest on the convertible debt, which of course is tax deductible. Dividends on the convertible preferred shares, which would not be tax deductible. So for the interest, it would reduce the amount of income. So when we convert the debt into common shares, then that interest is no longer paid. So interest goes away, and our income would go higher, would go up. We also deduct in the numerator of the earnings per share calculation the dividends on preferred shares. So if those preferred shares are converted into common shares, those dividends are no longer an entitlement of the preferred shares, and so they wouldn't have to be deducted in calculating the income available to common shareholders. So the weighted average number of shares would be increased by the additional common shares issued at the beginning of the year. So an example, net income for the year, $410,000. Common shares outstanding, 100,000. Additional securities outstanding, there's a 6% convertible debenture bond sold at 100 for $1 million, so it's sold at par. It's convertible to 20,000 common shares. There's a 10% convertible debenture bond sold at 100 for $500,000, and it's convertible to 32,000 common shares, and it's a 10% convertible debenture bond, so 10% of the 500,000 is sold at par, so it's nicely 10% of 500,000, so it's a nice $50,000 number. Both of these bonds were actually sold at par, so we don't need to worry about amortizing discounts and premiums and calculating the effective interest, but we would use the effective interest method if that was appropriate in this case. So we've got 2 different potentially convertible, potentially dilutive securities, and when we issue these bonds, we have to pay interest, And so if we get rid of the bonds, we can reduce the interest expense and increase income. So we're going to calculate diluted earnings per share. We're assuming a tax rate of 30%. So how would that work? Well, our net income for the $410,000, our net income for the year was $410,000. So we add back the interest on the 6% debentures, which is 6% of 100,000, so that's the 60,000. Of course, we get a tax deduction for those, so it doesn't actually cost us all the 60,000. It costs us 70 cents per dollar. So that saves us $42,000 after tax interest. So we add that back to the income because we wouldn't have to pay that if we had the debentures converted. The second debenture is 10% debenture, so the interest cost is 50,000, and it's also after tax at 70%, but it was issued on April the 1st, so January, February, March. It was only outstanding for 9/12 of the year, so we only save 3/4 of the year of interest because we didn't have to pay interest for the first 3 months. So 50,000 times 0.7 times 9/12 works out to 26,250. If the debentures were converted at the beginning of the year, we would have had net income of $478,000, $478,250. And then, of course, the weighted average number of shares, we assume that all of these converted debentures would have been issued either at the, for the 6% debentures, they were outstanding at the beginning of the year. So we assume that the 20,000 shares entitled by those debentures would be added for the entire year. The 10% debentures, if we scroll back here quickly, were convertible to 32,000 common shares, but the first quarter of the year they were not outstanding. So we would take 32,000 times 9/12 of the year, and that would be 24,000 weighted average number of shares because those debentures were issued partway through the year. So 144,000 is the number of shares the weighted average number of shares which would be issued if both of those debentures were converted. And so the if converted method always assumes at the beginning of the year, unless they're issued during the year, if a convertible security is not issued and is not outstanding for the full 12 months of the year, we prorate the conversion and prorate the amount of income. So we have 410,000 is our income before the adjustments. Take 410,000 divided by the 100,000 shares which were actually outstanding for the year. That's $4.10. When we calculate the dilution, we increased our income for unpaid interest after tax and divided by the weighted average of potential shares. So 144,000, so that's $3.32. It clearly is dilutive, which means that the amount of the earnings per share goes down if we spread it over more common shares. So we are required to disclose both. The Treasury stock method. The Treasury stock method, we basically take the proceeds of the exercise of the options and warrants, and we buy shares at the current market price. And so we get the proceeds and we spend it on new common shares, and so that reduces the amount of income per common share. So options and warrants are included in the earnings per share computations, and an option, as we're aware from previous discussions, an option in this case gives the holder to the right to either buy or sell shares. The right to buy is a call option, the right to sell is a put option. So generally speaking, the only time the holder of options would exercise the option is if the options are in the money, and so they're in the money if they can actually make money from exercising them. If the company sells options, they need to be included in the diluted earnings per share calculations because it's not optional. It's for them, it's an obligation if the holder of, or the purchaser of the option requires them. Purchased options will always be anti-dilutive since they're only exercised when they're in the money, and so they wouldn't be included in the earnings per share. All right, so the Treasury stock method, let's say we're looking at written call options and equivalents, which would include things like warrants, or other rights to purchase common shares at a stated exercise price for a stated period of time. So this is the right to buy at a certain price. So with the treasury stock method, we assume that the exercise happens at the beginning of the year. Then we take the proceeds from exercise. The exercise price is less than the market price. So unless the exercise price is less than the market price, there wouldn't be any dilution because you're getting the exercise price and you're buying from your treasury at the market price. So the only way the number of shares would go up in a dilutive fashion would be if the option was in the money. Okay, so here we have the exercise price of an option. For one share of stock is 30 bucks. The market price is 50 bucks. And we're looking at 1,500 potentially dilutive options. We need to calculate the incremental number of shares which could be created in that situation. So 30 times 1,500 is what, $45,000. And at 50 shares, we would create another, what, 9,000 shares or so. 900 shares. I'm decimal challenged. 45,000 divided by 50 would be 4,500 divided by 5. Yes, 900. So the total proceeds is 45,000. Then we buy, we issue 1,500 shares as a result of the option being issued, and then we use the proceeds, the $900, the $45,000 to buy another 900 shares. And so just a second here. The shares issued on the purchase of the option is 50. We issue 1,500 new shares as a result of the options, and then we use the proceeds. Okay, so we use the proceeds to buy back shares on the market at $900. So we buy them for Treasury, not issue them out of Treasury. That makes sense, going that direction. So that means we issue a new 1,500 and we buy back 900. That leaves us with $600 more outstanding. So that implies that we've got 600 more shares to spread our income out among. So it's dilutive in that effect. So more common shares are issued after the exercise than were outstanding before the exercise. Reverse treasury stock method. For written put options, so if we've written put options, we have given someone else the right to sell shares to us for a certain price. Forward purchase contracts would also fall into this category, where we've established a price in advance for the sale of our shares or the purchase of our shares. So the reverse treasury stock method is used for written put options, forward purchase contracts. It assumes the company will issue sufficient common shares at the beginning of the year in the marketplace to generate funds to buy the shares under the option or forward contract. And so we assume that we're going to sell shares at the market price at the beginning of the year. And so those are available. And then the proceeds from the above would be used to buy back the shares under the option at the beginning of the year. So again, the exercise price per share must be greater than the market price per share, because this is the right to sell at the exercise price and then buy at the market price. So you can buy them at the market price and then sell them at the higher exercise price. The only time the put option would be in the money is if the exercise price is higher than the market price. So an example of the reverse treasury stock method. The exercise price of the option is 30. The market price of one share at the exercise date is $20, and the options deemed exercise is again 1,500. So that means it gives our option holder the right to sell 1,500 shares to us at the exercise price of $30. So we need to be able to buy 1,500 shares at the $30 exercise price. So that's $45,000. Now the shares are actually at the market price of $20. So we need to pretend to issue those additional shares. So for $45,000 worth of shares at $20 each, that's 2,250 new shares we have to issue in order to satisfy the put option requirements. And the number of new shares purchased under the put option are used to reduce that. So we have to buy 2,250 to satisfy the put option requirements, and 1,500 is actually what's purchased under the put option. So that, so I'm not sure I said that correctly. If we get $45,000 from okay, let me. I'm not following this. Let me go have supper and then I'll come back. All right, I'm back. It was steak and potatoes lunch or supper that Connie made. So I'm feeling better now. Let's go back to the reverse treasury stock method. $45,000 is the amount of money that we need to be able to buy the 1,500 shares at the exercise price of $30. So we have to be able to pay $45,000. The reverse treasury stock method assumes we issue new shares in order to do that. So $45,000 is the amount we need to buy 1,500 shares at $30. So the current market price is $20. We're going to have to issue 2,250 new shares to generate the $45,000. So we have that $45,000 in our bank account to, well, in our imaginary bank account, to purchase the 1,500 shares at $30. So we have to issue 2,250 under the terms of the put option. Under the terms of the put option, we have to purchase back 1,500 shares. So we issue 2,250, we buy back 1,500. That's a net increase in shares outstanding of 750. So that essentially dilutes the number of shares using the reverse treasury stock method. So dilution occurs because the number of shares issued after the reverse treasury stock transaction is greater than the number before. So, quick little review. The treasury stock method is applied to written call options, any equivalents such as warrants or rights to purchase shares, and so any equivalent transaction where we're required to, we've given someone else the right to buy shares at a given exercise price in the future would be treated under the treasury stock method, where we assume that the proceeds that we get from selling the treasury stock, the extra shares, would be used to buy shares on the open market. And the reverse treasury method would be used for written put options, forward purchase contracts that require us to buy shares from the other side of the transaction. So the option holder can require us to purchase, or a forward purchase contract can require us to purchase shares at a certain price. So the reverse treasury stock method basically assumes the company will issue enough common shares so they have the money to buy the shares under the option requirements, and the proceeds would be used to buy back shares to reduce the number of shares outstanding, and the net amount would be used as the dilutive effect. Contingently issuable shares are also potentially common shares, are also potential common shares. So there's a possibility. So those would be things like employee stock options and management stock options, as we talked about. The idea of anti-dilution, we should talk about that. So anti-dilutive potential common shares are securities whose inclusion in the earnings per share calculations would actually increase earnings per share. So they would decrease any. Let me run that by you again. Anti-dilutive potential common shares are securities which, if included in the earnings per share calculations, would increase earnings per share or reduce the net loss per share. So that actually would be the opposite of dilution. We'd actually have fewer shares sharing in the same number of earnings available to common. So if that's the case, it doesn't get included because basic earnings per share is essentially a higher number. No, it's a lower number. Basic earnings per share is sort of the maximum. We only are concerned about dilutive securities because they distribute the income over a larger number of shares. So convertible debt is anti-dilutive if the addition to income from the interest net of tax causes a greater percentage increase in net income than the conversion of the bonds creates increase in the denominator. So if the numerator effect is higher than the denominator, it's an anti-dilutive effect. We basically save more money on interest than the further spread over the new number of shares would require. So numerator, bigger effect than the denominator, anti-dilutive. Anti-dilutive potential common shares are irrelevant because if they were issued, they would result in more diluted earnings per share calculations than the basic earnings per share, and so those numbers are essentially anti-dilutive. So securities that cause an increase in earnings per share, anti-dilutive, we wouldn't actually include those in diluted earnings per share. So we only compute diluted earnings per share for the potential common shares which are dilutive in their effect. An example, Coal Corporation has $1 million in 6% convertible debt, so $1 million, 6%, that would be $60,000 of interest. It's convertible to 10,000 common shares. So our tax rate is 30%. So we could save, if we converted all of them, we could save ourselves, what, 60,000 times 70, $42,000 in interest, and we divide that over the 100,000 common shares outstanding. It's $4.20, and basic earnings per share is $2.10, so it would be anti-dilutive. So our adjusted net income would be 210,000 plus the 42,000, so it would be 252,000. The adjusted number of shares would be 100 divided by, or 110, 100 for the existing shares, 10 for the shares issued on the conversion, and that would result in adjusted number of shares of 110. 252 divided by 110 is more than $2.10. It's actually $2.29. So because the diluted earnings per share is higher than earnings per share on a basic level, we would not disclose diluted earnings per share because it's anti-dilutive. So we could also test, I think this is the one that I was calculating, 42,000 is the amount of additional income. The incremental number of shares is 10,000. So the incremental earnings per share is 42 divided by 10. That's higher than $2.10. So it would not be dilutive. So it's anti-dilutive. If you did this calculation and got $2, then it would be dilutive because the increase would decrease, or would decrease income. It would increase income more than the compensated number of additional shares. So the net effect would actually be a higher earnings per share if it's anti-dilutive. Additional things to think about disclosing. You would need to disclose the key information about how you calculated the earnings per share. So in the notes of the financial statements, you'd disclose the amounts in both the numerator and denominator in calculating both the basic and diluted earnings per share, so that you could actually figure out what percentage is yours. And you would reconcile the numerator and denominator values for basic and diluted earnings per share among the income before and after discontinued operations. And any potentially dilutive securities that were not included in the calculation of earnings per share because they were currently anti-dilutive might actually change in the future. So if circumstances, the market value of shares, we use the market value of shares for a couple of calculations, especially with the options calculations, they could actually move to the situation where they're anti-dilutive, in which case they would need to be disclosed as potentially dilutive securities in the future, but not dilutive at the moment. You need to describe you'd have to include a description of common share transactions that occur after the reporting period that would have significantly impacted the earnings per share numbers as well. So any new issue of shares, a large number of new shares issued or something like that, would need to be included as well. All right, we've got a couple of slides left. It's 53 total slides. This is slide number 49. Additional things that we use earnings per share for. We use it for a number of analysis calculations, price earnings ratios, book to earnings, a lot of the analysis in the market value section or profitability section of the corporate finance course talk about using earnings per share to calculate things. So basically, it's a fairly significant number in terms of analysis. So earnings per share tells us how much we're entitled to as shareholders, and so that tells us basically whether management is doing a good job with our invested funds or not. It helps calculate the company's future value. There's usually sort of a standard price earnings ratio that we have in mind, and that the inverse of the price earnings ratio is essentially a rate of return on our $1 investment. So we use earnings per share in a number of calculations. The diluted earnings per share calculation is useful because it tells you who else could get a claim on your earnings, and so it tells you that there's a constraint or a limit, a boundary on the amount of earnings per share that you should include in your valuation calculations, because you're not entitled to all of the basic earnings per share in the case of dilution through conversion or exercise of options. So if you're in a situation where your earnings could be diluted, you want to know why. Comparison of international financial reporting standards in ASPE. Actually, let's take a step back here. Earnings per share is one of the most highly visible, as we said. It also provides shareholders with information that helps them predict the value of their shareholders their shareholdings, because it tells them what the boundaries are on their value. It's also useful in valuing companies in general. When the company shares are valued, then earnings are often discounted to arrive at the estimated value for the firm, and so it's basically there's a required rate of return that you assume dependent on the riskiness of the business, and that determines what the price earnings ratio should be. And in order to get a certain percentage return, you're willing to pay a certain price. That price earnings ratio has implications for value. So discounted cash flow calculations or net present value calculations are commonly used to estimate the value of those earnings and the amount of cash that they generated. The price earnings ratio provides useful information by relating earnings to the price that the shares are trading at, and it's sometimes used to generate a quick estimate of the value of the shares. Just you know what the earnings are, multiply that by the price earnings ratio, and so therefore it helps you value the company. It allows an easy comparison with other companies, and so the information is readily available because the price is published on 15-minute delay for most of us, and the earnings per share is information that's readily available in the income statement, and it's also commonly published in quarterly earnings reports as well. So we have a pretty good idea what the earnings per share is for our business. So if you consider the hundreds of financial reporting choices, such as accounting methods, measurement uncertainty in estimating the life of assets or the salvage value, all of the other stuff that could affect the financial reporting choices, the constraints or the boundaries on the amount of earnings attributable to your shares is an important measure of how much value you have attached to your shareholding in the company. Easy for me to say. Now, ASPE versus IFRS. Earnings per share is one of the most frequently used standards of measurement for assessing management stewardship and predicting a company's future value. Diluted earnings per share is particularly useful if there are potential common shares, which is the case if we have convertible securities, options, warrants, other financial instruments that could increase the number of common shares outstanding. So shareholders need to know how those instruments can actually affect their investments. The International Accounting Standards Board is developing standards to ensure greater transparency in earnings per share calculations, so there's new information that will be required in the future. Standards are basically converged between ASPE and IFRS, except for ASPE does not prescribe standards for calculating earnings per share at all. So essentially, earnings per share standards are only applied to publicly accountable entities in Canada. Earnings per share is not required in ASPE, but the techniques of calculation would be the same if they chose to disclose it. So, only applies to publicly accountable entities in Canada, private enterprises that choose to apply IFRS. Is there more? Earnings per share standards in the future. Are still under development. As I said, the International Accounting Standards Board is working to develop standards to ensure greater transparency in earnings per share calculations. It's a fairly complex area, as you have discovered. The calculation is not that simple to do, so more transparency is probably a good thing. And that's it for Chapter 17.